Welcome to the Cash Flow Champs podcast, the show where we demystify real estate investing so you have the tools you need to gain financial freedom through passive investments in real estate. And now your host, Cash Flow Champs Managing Partner, Prashant Kumar.
Hey, this is Prashant Kumar from Cash Flow Champs. Today, we are on Cash Flow Champs Real Estate Podcast. With us today, we have Jeremy Roll, the President and CEO of Roll Investments Group. Jeremy, thank you so much for taking time. Welcome to the show.
Yeah, absolutely. Thanks for having me. I just hope that our episode is helpful for your listeners.
Awesome. Jeremy, I'm going to introduce you formally. You started your career in real estate in 2002, and since 2007, you became full-time passive investor, right? You left your corporate job, and you currently have more than 60 opportunities worth more than $1 billion where you have passively or actively invested. And obviously, you founded, your Roll Investment Group. You manage a group of more than 1,500 investors, who invest passively, managed cash flow investments in real estate. Jeremy is a co-founder of, For Investor, By Investor, nonprofit organization that he launched actually in 2007 with the goal of facilitating networking and learning among the real estate investors in a strict no sales pitch environment. FIBI is now the largest public real estate investor meeting in California with over 30,000 members. Awesome. Jeremy has an MBA from Wharton School of Business. He's an advisor in Realty Mogul, the largest real estate crowdfunding website in United States. Jeremy can be reached on his email, jroll@rollinvestments.com. He's always there to help network with other investors and to discuss real estate or business investments of any size. Jeremy, once again, thank you so much for your time. As we were discussing earlier, the purpose of this podcast is to motivate a lot of busy professionals, right? There are a lot of people who have a lot of money sitting and the money is not working for them. It's basically they are trading their time for money. They have money sitting in their bank accounts. They are putting money in stock markets, and they are not getting the best out of what they have accumulated, the wealth that they have accumulated, and it is depreciating day by day. With the inflation, 7, 8, 9%. They are actually losing the value, and they think that they are making more money. They are, in a sense, they are losing money day by day. I just want to talk to you, with your background, for last almost 21 years in real estate. Tell me a little bit more about uniqueness in your background. We want to hear from horse's mouth, if you don't mind.
Yeah, sure, absolutely. So I guess my story is that I also was in the corporate world for many years, over 10 years experience. My last two jobs were at Disney headquarters and then Toyota headquarters, both in Los Angeles. Those are my last two. And I started investing passively in 2002. And I did that as a response to the dot-com crash. For everybody who's old enough to remember that, I was just sick and tired of the volatility and more importantly, even the lack of predictability of the stock market. And watching the stock market go up and down to 30% a year just wasn't for me. So I looked at different ways to invest, concluded that more predictable cash flow would be the right fit for me. And that's how I started down this path in 2002. And what happened is that I actually wanted to have the paycheck and the passive cash flow just for more predictability for my retirement account. But I had a last strong moment in the corporate world back in 2007 with my manager at the time. And I had enough cash flow built up to live off of. That wasn't the intention, but I decided to take a risk and leave the corporate world back then. And so I could definitely relate to people being in the corporate world for sure. Worked for a number of very large companies and also a couple of startups. And I've been very fortunate to have been out of the corporate world now for over 15 years, almost 16 years from the passive cash flow. So I tend to focus on lower risk passive cash flow for more predictability. That's just a better fit for my personality. I just try to keep my cash flow snowball going so I never have to go back to the corporate world. That's my main goal.
This is awesome, Jeremy. I mean, you took a plunge 21 years ago, or no, actually not 15 years ago. You started in real estate 21 years ago in 2002. And you were in corporate world for 10 years. your story is somewhat related to my story also, but it took me a long time to get out of the corporate world. Partly because I was very busy. Just a little bit about myself. I was in the corporate world for 25 years, as a consultant. As a consultant, I was making like top dollars. You can think of as a consultant, I was making like the topmost dollar that anybody could make in an IT consulting company. And but I got out, you got out 15 years ago. I got out about 15 months ago. I started real estate in 5 years ago, but in 5 years, I was able to gain enough cash flow for me to sustain. And I could, I don't need to tell too much information, but I could actually easily double my net worth in these years. So that is a little bit of my story. But I know you are very conservative in a risk-averse kind of a investor. What do you think are the benefits of passive investing? What is your viewpoint? How do you help others to gain financial freedom?
Yeah. So I'm not a financial advisor, an investment advisor, or anything. I'm just a passive investor. I do have many calls helping people just brainstorm what to do, how to get out of the corporate world. I actually love seeing someone create a plan and then execute it over multiple years, because it's not a get-rich-quick scheme. It takes a long time. And then watch them get out of the corporate world. That's my favorite. I tend to, as you mentioned, focus on more low-risk passive income. I like to be highly diversified. And one of the things I'll say about the benefits of passive investing is that obviously you don't have to do the work, right? So all the work you're doing is upfront in analyzing the deal, analyzing who you're making a bet on. And then once you make that decision and send the funding in, then the work is no longer yours. Now, you do have to monitor the opportunity. You have to make sure it's on track. And if it's not, you need to understand why. And usually there's not much you can do about it either way, but you do need to monitor in case there is. But once all the upfront work is done, and if you're with an experienced sponsor who is executing well, then you can get many years of passive cash flow in the right asset in the right location with the right manager. So the lack of work is a huge benefit. The ability to get more diversified, I think, is a huge benefit, right? So instead of putting $500,000 into a house, you can spread it across 10 houses in a passive way, right? I'm just making those up, but so you could put small chunks across a lot of things. And I'm kind of biased because I'm kind of hyper diversified and in over 60 different LLCs right now. I've been in over 150 to 200 over the past 20 plus years. And so I'm a little over diversified probably for the average person, but I do it full time. So it's a little easier to accomplish that. But you get to be diversified across asset classes, geographies, and operators when you invest passively. And I think that's very important to do because you do have an additional risk where you're making a bet on somebody else who has control. You're giving up control for diversification. And so when you do that, you have to be really well diversified because now you have an additional risk of fraud, mismanagement, Ponzi scheme, et cetera, what I call 1% risks. So, but I think there's a lot of benefits to passive investing. We can get into more of those, or we can even get into some of the, the pros and cons and the cons as well. But I can tell you that the one thing that I really love is that, this is a very mostly unknown type of investing, and cash flow to me is absolutely king. Got me out of the corporate world, changed my life, gave me the option to build my own schedule. I know we don't have to get into huge specifics, but it helped me in so many ways, where I needed the time for health reasons, for my family, whatever it was. And it could really change your life. I mean, it's completely changed my life. Unfortunately for me now, I almost take it for granted because it's been so long, But when I think back at the corporate world and I felt like I just wasn't maximizing my potential despite having some fantastic job and some great companies, this allowed me to really maximize my potential and gave me the freedom to do that.
Wow, this is awesome that you are diversified across geographies, across asset classes, and across various sponsors. So what are the best ways to find those different opportunities? I mean, how do you go about? I mean, we are in multifamily. I primarily invest in multifamily, and I invest in assisted living, and I'm an active operator. But I would like to know, you being a passive investor in a way, how do you go about vetting all that? It's a lot of information, help me understand that a little bit more.
Yeah, sure. So the challenge for sure is finding opportunities. And there's two reasons. One is that you have to be an accredited investor to get access to all the opportunity or most of the opportunities. If you're not an accredited investor, it makes it significantly more challenging. You can only invest in a fraction of the opportunity. So that's number one. That's an important point. Number two is I get to network full-time to find opportunities. And I've also built networks that have then provided me with a lot of deal flow. So I put a lot of time into building networks over time. I also went in person to many, many meetings when I was much younger here in Los Angeles. And so it was a question of building a network over time. And now, if you want to go directly to be able to invest with sponsors directly, that's what you have to do. If you are in the corporate world very busy and don't have the time or the interest to network, then you can access opportunities in other ways, but they're typically going to be through intermediaries where the risk is the same, but the return is a little bit lower, right? Because someone's in the middle, which is fine. I mean, there's a lot of value to that for some people. That could be accessed through crowdfunding sites, through investor groups who actually find and vet opportunities. And those are probably the two primary ways. As far as finding sponsors directly, a lot of people like to listen to podcasts and then vet some sponsors by listening to them. I'm a huge fan of going to large conferences because that's a very efficient use of time to meet hundreds or more than 1,000 people sometimes. And there's also online forums and some online websites that are actually online forums of discussing opportunities where you can be amongst other investors in an accredited investor environment and to see what people are posting about opportunities they're looking at and find sponsors that way as well. But there is a lot of networking and a lot of work that goes into this. And if you're not interested in it, it's still definitely feasible, but then you're trading off a little bit of return for an intermediary.
Awesome. I think what you said, and I like that, going to these conferences, you could meet like hundreds and thousands of people, different operators and talk to them. If you have to do it yourself, one by one in a forum or online, you're going to be spending a lot of time. So I kind of agree to you that your favorite mechanism is to go to these conferences.
Yeah, I just think it's really efficient. Another thing that was very beneficial to me, but most people don't have the time or interest to do probably, is I started my own investor groups here in LA with no sales pitch and met a lot of people, hundreds and thousands of people that way. I actually co-organize a conference and I meet a lot of people that way. But those are, I understand, like difficult initiatives for someone who's already working, right? I actually started those in-person investor meetings in Los Angeles after I finished working. That's what I did. The first thing I did with the extra time. So, but networking is a key component to this. And if you're not interested in networking and don't have the time, you definitely have to take a different approach.
Yeah. So what were the challenges that you faced, if any, during your early stages of your real estate investment journey? And how did you overcome them, if at all?
Yeah, absolutely. So when I first started, I not only had those challenges, but I was actually new to the US. I'm from Montreal, Canada. That's where I've lived half my life. I grew up there. And then I came out here, did an MBA over at UPenn or Wharton. And then I started working in Los Angeles in the year 2000. And in 2002 is when I actually started looking into all this type of investing. And the biggest challenge I had at the time in the US is because I hadn't built a big network here, I didn't know who to trust, right? Because you're trusting someone with your money, you're giving them control over the major decisions and the daily operations. So what I did to resolve that is I actually was very lucky. I had lifelong friends in my family out of Montreal who had actually been a sponsor, or at least they'd been a sponsor for, at that point, probably 10 to 15 years. And so I started with them, even though it was a different currency, different country, and I knew the country well, but there was a currency exchange risk and everything, because I knew if I start with them, I'd be able to learn. So I kind of leveraged that situation to learn a lot from them on the ground, site visits, a lot of conversations, looking at pro formas. And that actually started in the asset classes of retail, office, and industrial, because that's what they were focused on. But that's okay, because I feel like almost any asset class, 80% of what you learn is the fundamentals, and you could transfer 80% to like the next asset class. So I was very lucky because I was in a position I knew that I could trust them and I knew I could learn from them. And that's how I started. And then what I did is I layered in going to a lot of in-person meetings. Now, those have become less common because there's virtual meetings and conferences, all these things and online that didn't exist when I started in 2002. But I didn't have kids at the time, and I took advantage of that and I put the time and work into it, especially with the traffic in LA after work. I went to about 2 to 3 meetings a week for years. And that's actually why I was motivated to start the nonprofit as soon as I left the corporate world, because of the fact that a lot of those meetings are sales pitches. And that sometimes you have to sit through an entire sales pitch just to network with a really big group of people in the end, which is worth it at times, right? So a lot of the meetings, I would sit in the back row of the meeting not pay any attention. I literally bring my work, not listen to the meeting, do my work in the back row for like 2 hours. And then at the end, I would network with people. So I did a lot of in-person meetings and networking to build a network, and then start to like look at other asset classes, learn about them in some of the meetings, and start to like build the network of finding opportunities.
That's very inspiring. I mean, 15, 20 years ago, there was no online stuff. The Zoom thing started popping up in last 4 or 5 years only.
Yep. There's no online. Yeah, there was no online, no podcast, no conferences, no crowdfunding websites, right? No online, no apps, obviously. It was a totally different world, and it frankly was much more difficult.
And I must tell you, even though we have a lot of online stuff nowadays, we can do a lot of things online quickly. I must tell you that most of my investors, whom I connect, with whom I have shaken a hand, most of the folks I would say 75% of my investors are those whom I have shaken a hand, not just meeting online. I mean,
yeah.
I think in terms of the time value of money, I get more bang for my efforts, when I raise equity for projects, when I have gone and met the people and have looked into eye-to-eye contact, and shaken hand and talk to them for 15, 20 minutes rather than just talking online. What is your take on this?
Well, it's funny you should ask, because to be totally honest with you, like I've attended some conferences virtually as a panelist or a speaker. Like I'm actually speaking one tomorrow, but virtual. And I've also tried some of the online networking after the end of those sessions. And there is networking, but it's not the same. It's not even close to the same. You just don't get the same sense for the character of a person, which I think is very important before you invest with them if you can. You also, there's a lot of cool software that enables the networking, but it's not perfect. And being in a circle of, say, like, in person of 4, 5, 6, 7 people where you can learn a lot and talk right there, very difficult to do online. It's usually a one-on-one conversation. So there is networking online. It's not like there isn't, and there is value to it, but I think that it's a better version in person.
Oh, yeah, that is 100% true. I mean, if you are 7 of you standing in a circle, you can talk to almost 7 of them at the same time.
Yes. Yeah. And sometimes you get the benefit of standing with someone who's very knowledgeable, listening. Everyone's listening to this person, and you cannot do that in the virtual networking. It's very difficult. So again, this goes back to also like, does the person have time to network? Are they too busy? Are they too busy in their job? And some people really don't like networking and don't have the interest in doing it, in which case you could take the other path of going through the intermediaries and finding opportunities still.
So how do you inspire and encourage listeners to take advantage of the offerings that come across your table? What are your mechanisms? I mean, I'm sure you invest, and you may want your friends or listeners to invest also alongside you. How do you inspire and encourage them?
Yeah. Well, it's funny because it's usually the other way around. I've done so much networking over time that I get a lot of people sending me opportunities, and then I might discuss it with them. Now I'm so constrained because I'm so busy that I normally can't review something and just give it like consulting feedback. I don't have time. But if I look at something and it looks good, I'm going to start digging into it. And then the greatest part about networking, like to me, passive investing is a team sport, and you can benefit from the knowledge and perspective from somebody else. Like I can't tell you how many times I just invested in a deal in Dallas. Okay. And I've invested in many deals in Dallas over time, but someone I know there is not only the largest mortgage broker in Texas, but also drove by both properties and sent me a video of it. Right. So, and then getting his expertise and his perspective on the lending side and my understanding of, the sponsor who I'd invested in for over 10 years, like just, 1 + 1 = 3. And often when you have that approach with other investors, it can be very, very powerful. I also like to trade information with investors or investor groups about feedback about sponsors, right? What has their experience been? How do we avoid the pitfalls and the landmines? And that's very important. And one other thing I want to share is that I think that background checks for passive investors are an absolute must, mandatory. I even redo my background checks when I'm reinvesting with someone. I do it usually at least once a year. It's just, it saved me several times, very obviously, from some type of fraud or someone that wasn't a good person. So that's another thing I find most passive investors don't do, but that should be added to their list as mandatory as well. So, but the point is that, like, I definitely network with a lot of investors and try to give feedback. I personally take a lot of calls from new investors who are just trying to understand the landscape. I don't charge anybody for the time. It's one of the benefits I have from having the time is I'm able to, one of the ways I give back is really to give the time to speaking to other people to help them learn from my experience, so to speak, right? So again, I'm not an advisor, but I'm happy to, just to give some feedback and a perspective.
This is awesome. I mean, I mean, yes, I know a lot of people do the background check, but I personally, to be frank with you, have never instituted that in my business. And you saying that you do it once a year, even if you are reinvesting with the same operator.
Yes.
That is powerful stuff, So tell me.
Yeah, I want to be clear. I don't do it every year if I invest with someone already, right? To check on them. I don't like that because that would be very onerous and a lot. I do it. So a great example. I'm about to invest in a new fund that's launching for ATMs, not real estate. And I'm not only I just redid my background checks from last year, but I'm actually now redoing my in-person due diligence on site because it's been a couple of years, like since before the pandemic. So I'm going through all the head office visit, all looking at the documentations, their terminals in person, going through looking at ATMs in person and retail. I'm just starting it from scratch again. You just never know, right? So I think it's very important to do. The background checks are really easy. You run them on a computer. It takes a few minutes and it costs some money, but it could save you a lot of money. So the cost benefit is really there, huge, very good cost benefit and piece for that.
What else would you, I mean, I know you do all the due diligence. You said, you go to the head offices, you go to the locations, you look at the documentation, you do the background check. That is super awesome. And I mean, a lot of people, busy people, who probably don't want to do that or don't have the insight to do all that.
Yeah, I mean, so I'll say this, two things. First is that I have a rule that I won't invest with someone unless I've met them at least in person once and beyond a background check. That's just a gut check. And I realize that there's a lot of people out there who won't be able to do that from a time perspective, but it decreases risk. So that's something else to consider because the gut check I've always found to be extremely important for me. And as far as analyzing opportunities, there are some books now that help you to kind of get a sponsor's perspective or even a consultant's perspective on how to think about opportunities, vet opportunities, et cetera. And so that I would recommend if somebody's starting from scratch. Once you have done this a number of times and understand how the pro formas work and what to look for, expense ratios, cap rates, loan details, all these important things. Like I said, you could take it from one asset class and transfer it to almost any other one with some tweaks. So that's one of the great things about getting diversified is that you don't have to learn each asset class from scratch as far as having to vet it. You do have to learn the key things to look for in that asset class, but you don't have to start from scratch each time.
Well, this is a great answer. I mean, I must tell about myself when I can do it, when I was able to do it for the last 5 years, and I'm sure all the listeners should be able to do that, what you are doing, Jeremy, because obviously, this is something that you are creating on the side, even though you are a busy professional, it is your your moral duty to protect your assets. And as you start learning one asset class, you said 80% of that is applicable to other asset classes anyway. So, this is a great thing that people should take a note that, learning and then making sure where you are investing is the right asset class, right operator, can save you a lot of money.
Yeah, I just want to add as well that I would normally recommend that people start with one asset class because it's easiest to focus on one. And frankly, I'd recommend focusing on the one that you can understand the best from the start. That's easiest for you to understand. So if you lived in a mobile home park for most of your life, start with mobile home parks. It's going to be easy for you to start vetting them immediately, right? A lot of people start with apartments for two reasons. One is because they've lived in an apartment, understand the business model is fairly simple and straightforward compared to some others, so they can relate to it. And it's probably the easiest types of opportunities to find in that if you think about in a big city, or most cities, there's a lot more apartment buildings than most other asset classes, if all other asset classes, right? So a lot of people tend to start with apartments, learn that, try that, and then go on to other asset classes as well. But start with the one that's easiest for you, and then learn the basics of that, and then transfer it. But make sure you focus on one asset class to start.
That's the real nugget, guys. I mean, don't jump around from storage to multifamily to mobile home park and to ATM just in the search of gold. Gold rush. There's nothing like that. You may end up hurting yourself. Start
Yes.
with one, stick with one for some time, then jump. Once you have mastered it, then probably jump into another one, because your knowledge is your knowledge. Nobody can take it away from you. But by gaining more knowledge in one asset class, you will end up making better decisions for your and would be able to protect your money. That's what I guess you are saying, Jeremy.
Exactly. Yep.
Okay, so I mean, Jeremy, tell us some good experiences you have had in passive investing. Were they surprise to you, or just tell us something which
God, where do I start? I can go across a lot of different things. I will say that I've been. The funny thing is, what comes to mind, which is a little ironic, is that 99% of my focus is low risk passive cash flow. 1% of my focus is in startups. And I actually don't look for startup investments because they're the wrong profile for me. But what happens is that sometimes I have to make a bet on somebody. It's like, I'd be silly not to make a bet on this person who I know. And then I kind of like the idea well enough and it fits within certain criteria I've created for myself. And I've been very fortunate to have some very amazing, multiple returns in some companies that maybe some people would know. And so I've been very fortunate with that. And I've been able to then take that money and reinvest it into more cash flow, which has been fantastic. I'm invested with the 5th largest operator of ATMs in the US, and I've been invested in ATMs since 2008. Not with that operator, it's a different operator, but the second operator came, the larger one, in 2017, I think. That's probably been one of my favorite consistent cash flow sources of all things. I've actually averaged, I don't know the exact number, I'm not backed into it, but let's call it like about 30% cash on cash per year since 2008, right? So that's like 15 years later. And by the way, when you compound that return and keep reinvesting, the compounding is amazing, right? I've invested with the largest private owners of mobile home parks in the US, largest portfolio, over $1 billion since 2009. They've done an unbelievable job. I think, I know this is going to sound crazy, but I think they literally added an additional 2,000 homes into their mobile home parks across the portfolio in the last 2 years alone, or 3 years alone during the pandemic and stuff. It was crazy. So they've done an unbelievable job. And mobile home parks are one of my favorite asset classes because it's one of the lowest turnover rates. Most people stay for a very long time for a lot of reasons. And if you own you have to invest in the right type of park in the right location. There are different types of parks with the right managers, but that's a great cash flow vehicle. And I want to preface something we didn't talk about today, but I will say I do find it to be a very dangerous time to invest right this second. So these are asset classes I like, but some of them don't really make sense at this time unless they're very unique opportunities. And so, it has to be the right timing. And I think that's something we didn't discuss today. It's very, very important because I speak to a lot of new people who call me up and say, okay, I just saved up my first batch of money. I'm looking for my first opportunity. And the first thing I say to them is, do you have an opinion about where the real estate cycle and economic cycle are? Have you thought about that? And most of them don't think about that. They're like, okay, I want to save the money and get ready and go. But the problem is that it doesn't mean that the timing is right. And if you don't invest in the right timing, you can really shoot yourself in the foot. And I'm just going to give an easy example for everybody to understand. If you called me up in January of 2007 and said, I've got a lot of money, I just saved it all up from the last 3 years, how do I find 5 opportunities to invest $1 million? I would tell you, this is the wrong timing, right? And in retrospect, now that's correct. And I like using that example just so people really understand what I'm talking about. Because right now, we're in the middle of prices adjusting, and we're recording this in February of 2023. Interest rates are continuing to go up. Prices have come down, and in my opinion, are probably going to go down more. There's a very high probability of a recession in the second half of this year. And when you add all this stuff up, if you invest today, you may be going into an asset that's worth less at the end of the year, which is really counterproductive. And so you have to look for very unique opportunities right now. And so I'd like to tell people it's a great time to learn because, you're not missing out on that much while you're learning today. And then you may get in at the exact perfect timing, right? Imagine getting in at 2009 and starting your investing career then. That's the same idea that might be coming up in a year or two from here. So great time to learn, not missing out on that much right now, but don't be overly zealous to invest. At the same time, it's very subjective. So you may find it's a very good time to invest. That nothing wrong with your opinion, right? Just make sure you've taken the time to understand where we are in these cycles so that you're not just randomly jumping in without understanding that and mistakenly shooting yourself in the foot. That's what I'm trying to say.
Well, what you said just now, Jeremy, that is $1 million answer to a lot of folks, all these new people, who are willing to jump in, and most of them, those who are new, I mean, they'll end up hurting themselves, because they were new, they didn't have the insight to understand where they were in the market cycle. I mean, I'm a CCM also, so I understand this completely, what you are talking about, but February of 2023, this is the time when you should be patient. You should have patience, take a step back, learn, prepare yourself, and wait for the opportunity that is coming down the pike, hopefully in 12 months from now, and you get in at that time, that could take you for a ride. But if you get in now, you will not be able to come out of the deal. I mean, I think that's what, Jeremy, you are mentioning also.
That's right. You're just increased risk at the moment. And the greatest part about this, and we're talking about this at this timing, is that it doesn't appear like we're going to have very long to see how much the interest rates go up. And also it doesn't seem it's going to be very long until we figure out if there's going to be a recession and what the impact will be, right? So the risk is high, but the timeline is very low to avoid the risk. And that's a really good equation for somebody right now.
Yeah, I mean, in my mind, maybe it's 12 months, at most,
Yeah.
where we start seeing a lot of opportunities, which could take you. I mean, if you get in at that time, hopefully that will take you for a ride for the life, I guess.
Yeah, that could be possible. So, and I've had, I know we got sidetracked in my answer, but I've had a lot of I've been very fortunate. I've invested with an apartment operator who does low-income housing tax credit and tax abated opportunities. And in the last 2 years, it's been very difficult for me to feel comfortable investing in anything, and even multifamily. But I've invested in a whole number of these tax abated opportunities, which add a tremendous amount of value at closing without any execution or operational risk. So much padding that I was comfortable going into them. I could share some numbers, but so I've been very fortunate to find some unique opportunities during difficult times, and then just find some good operators overall. But I will say, in my opinion, the operator is more important than the opportunity. They're both extremely important, but if I had to choose, the most important would be who you're making a bet on. I like to give people the very simple example. I live in LA, I live close to LA, which is, you can invest in the best building on Rodeo Drive in Beverly Hills in the most prime with great tenants. But if that person runs that building to the ground, you're going to give the keys back. You're going to have nothing. You're going to lose your equity, right? And then vice versa. You can invest in the worst building with the best operator who executes flawlessly, and you've made a boatload of money in like a very bad area, even potentially, right? I'm not saying you should do either of those, but I just like giving the really easy example. So who you're making a bet on is absolutely imperative.
This is super awesome. I mean, these kind of nuggets you can get only from those who are experienced in the real estate, not from somebody who is new, a couple of years under their belt. Yes, people are learning, but those who have seen it all, I mean, you're talking about 21 years, 22 years of experience. Any bad experiences, Jeremy, you have had in your journey?
Yeah. When you take enough swings, it's impossible to bat 1,000, even though I like to think I can, but the reality is you can't, right? So if you're in enough deals over enough time, and that's why the diversification is so important, right? And so let's see, I've had some very interesting stories. I'm going to give you, so this is a really good lesson for people. They'll take a minute, because I tell everybody, I could tell you 20 ways a deal can go bad. Creative ways, right? You could be in a 300-unit apartment building in the best location that's 100% occupied and been really well managed with great managers, but then there's a fire. Half the building has to close. The insurance company says they're not paying, and then you have to fight them in court for 4 years, and now you can't actually pay the debt service. You get foreclosed. You can't even afford the legal fees for 5 years ongoing to try to get some of the money back, and then you lose the case, right? So that's what I call, I mean, obviously that's very pessimistic, but that's a 1% risk, and they're real, right? And they can happen. So let me tell you about a 1% risk that I actually ended up in, and the outcome, which was, the whole story is fascinating. So I invested in a 303-unit student housing building first property across from a state university campus in January of 2008. And I was very concerned at the time about the recession that was coming up. I had been on the sidelines since 2005. But I actually, my theory was that people will go back to school when there's a downturn. And they'll go, and that was actually 100% true. So this building was 100% occupied all the way through 2008, 9, 10. Very experienced sponsor. They own 17 different properties. We had assumed a loan at very favorable terms as well at the time, right? The problem is that loan, I normally invest in 10-year fixed rate loans just as a general, just for that predictability. So we assume a loan and it comes due in, call it like May or June of 2012. And in the spring of that year, the city sends a letter to all the residents and the owner saying, listen, we have to shut down the bridge to campus over the summer to do repairs because we're not going to do the repairs in the winter time because it was in Michigan. And but they said, don't worry, it'll be done in time for your school, right? Well, what happens? Student gets worried that they're not going to be able to get to school next year. We go from 100% occupied to like 60 or 65% occupied. Okay. Now that was problem number one, and it was manageable for a year, and it was actually about a break even. Okay, which is actually really good if you think about it because of favorable loan and everything else. Okay, problem number one. So domino number one falls, right? That's like 1% risk, of course. Nobody can predict that. Then the loan was due that fall. That's domino number two. It could have been due any year. It was due that fall, the loan, okay, to be able to sell or refi. Well, that wasn't doable because we were at break even at that point, right? So the value of the property is significantly lower that 1 year for the next 12 months compared to any previous or future year, right? So then the lender normally would extend the loan and see the situation. They don't want to take the property back normally. They actually saw the situation and said, we want the property back because it's a fantastic asset. So they foreclosed. It's the only foreclosure I've ever been in. They foreclosed on the property because they wanted the property. The sponsor had a partial recourse loan that they had assumed. So they lost millions of dollars on that. And amazingly, the sponsor, without anybody asking, transferred. So they own most of their properties themselves. They sponsored a few of them, but they own most of them. They actually transferred all of us out of their own equity to another property. It was the first property across from a state university in Texas. And the whole process took about a year with legal documents and accounting and all this stuff. But I'm still cash flowing today as a result of that foreclosure, having been transferred because the sponsor thought that was the right thing to do. They felt really bad. So they lost millions in recourse loan. They lost millions in equity to transfer to people. But that's what I talk about, making a bet on the person. So many lessons there, right? Because you're making a bet on a person. And even though they had the wealth, they didn't necessarily need to choose to transfer everybody because none of it was their fault. They wouldn't have been found any negligence or anything or mismanagement, right? But they chose to do that, right? Which was important. So that was their personality. They had the wealth to do it, which is an interesting lesson too. Those are 1% risks. And normally when you invest in a 100% occupied building, I tell people it's like a new airplane. 6 dominoes have to fall before you crash. It's not like one system that fails. There's backup systems. So that's why I was mentioning all these dominoes fell and all these 1% risks aligned, right? And so that sounds almost as far-fetched as like the building burns down, the insurance doesn't pay. Like really, it's those 4 dominoes that have to fall. So you have to be diversified, even if it looks like the most obvious deal. And this is a really good example of that, and also an example of how important it is to make a bet on the right person.
Wow, that is, I mean, that really tells that, obviously, it's not about just the opportunity. I mean, this example proves that it's about the operator who is doing it, even though it was a worse, it happened, but you are still, after like 10 years, 15 years, you are still cash flowing on that because
Yes.
the operator did the right thing.
Yes, that's exactly right. And the lesson there too is that, if you invest in a wealthier operator, they have more flexibility, either to be able to provide short-term loans to the property versus a cash call if something comes up, to be able to afford legal fees if something comes up, to be able to do this if there's a weird situation comes up. So I'm not saying you have to cover all these 1% risks and everything you look at that you're investing in, but I am saying diversification is absolutely key.
Wow, that's awesome, Jeremy. We will, we are running short of time. I want to respect your time also. Let's do some quick questions. One piece of advice that impacts your life and how do you think that it may impact others?
Absolutely. This is a slow and steady type of investment philosophy. Don't get into this if you're looking for quick cash. I would definitely discourage it. I would say that delayed gratification is absolutely key to life and very key to building up consistently building a cash flow snowball, which in the long term is really worth the work that takes.
Share one of your personal habits that contributes to your success that you think will benefit our busy audience.
Yeah, I am very organized and very focused, and I work very hard. In fact, I would say I work harder now than I did in the corporate world, honestly, more hours and more focus. But I'm a huge believer in hard work and proper focus and being well organized. And that for sure has contributed to where I've gotten to today, no doubt.
Any book that you would recommend on passive investing to listeners, and why?
Yeah, absolutely. There's actually two books I'll throw out there really quickly. And I would recommend reading this in this order if you're new and you want to learn about apartment investing as, let's say, your first asset class. Brian Burke, Burke, has a good book that's kind of higher level. He's a sponsor, and he provided his perspective as a sponsor on what he thinks you should look at, which is really great. And then Rob Beardsley, Beardsely, he has a book. They're both on Amazon. I don't know the names of them. He's actually a consultant that does underwriting, and he provides a more in-depth focus on what you should be looking at when you're trying to underwrite an opportunity. Those two in that order. One more. I'm a huge fan. If you're not started this investing yet, and you're still trying to figure out what to do, I always recommend Robert Kiyosaki, Rich Dad, Poor Dad, and Cash Flow Quadrant in that order. Most people aren't familiar with the second book, but read both of them in that order: Cash Flow Quadrant and Rich Dad, Poor Dad first, Cash Flow Quadrant second.
By the way, I gave both the books, Rich Dad Poor Dad and Cash Flow Quadrants to my daughter when she was 10-year old, and she still remembers each and every time she tells me that this is dead. And both the guys, Brian Burke and Rob Beardsley, both are good friends of mine.
Oh, good.
I met them many times, interviewed them many times. So great choices. Tell me, basically any parting advice for anybody, any other thoughts that you have in your mind?
Yeah, I just can't stress enough what we talked about earlier, which is just be very careful right now. There's nothing wrong with investing. Everyone has a different opinion, but make sure you formulate a proper opinion about where the economic cycle is and the real estate cycle is. They're different before you get into anything if you're just starting out. Great time to learn. And I think it's going to be a very good time to invest in the next year or two.
Jeremy, thank you so much. I know you can be reached at JRoll. Maybe you can say your
absolutely. Yeah, absolutely. Yeah, anyone's welcome to reach out to me if you're brand new. If you're another investor that just wants to network, if you're an investor group that wants to network, if you're a sponsor that has an opportunity, my email address is jroll, JROLL, @Roll Investments, ROLL Investments with an S.com. So jroll @rollinvestments.com.
Is there any social media or any place they can connect you with?
I have literally no social media, no website, no nothing. I'm very under the radar. I'm just too busy for all that, to be honest. So unfortunately, there's nothing else but email.
Well,
actually, there is LinkedIn if you want to see my history, my profile. I'm not actively on there, but you can see me on LinkedIn. I'm sorry.
Well, that's good enough. You don't have to be everywhere, while you can do good things while being under the radar. And that's what you have been doing. You have we read about it. You do a lot of stuff. I personally have met you. I don't know whether you remember it or not. Whenever, I don't remember where, but I'm sure I have met you in person. But again, this is a big world, and I'm glad and honored that you took time to talk to us today and give the valuable information to our audience. I'm humbled. Thank you so much, Jeremy.
Oh yeah, no problem. Look, I just hope it was helpful for everybody who's listening, and for those of you still with us, thank you for watching.
Awesome. Great, Jeremy. Thank you so much.
Thank you for tuning in to this week's episode of the Cash Flow Champs podcast. Cash Flow Champs partners with busy working professionals and entrepreneurs that want to build and maintain generational wealth through real estate. Visit cashflowchamps.com to learn more about us